Charles Ortel is here with me, and he provides research and advice on GE to professional investors as the managing director at Newport Value Partners. And the advice you've been giving investors, though, has been, of course, to stay away from GE. Some have talked, including Nick Heyman, we had a conversation with him earlier, that this may, in fact, be a turning point for General Electric.
I honestly just don't see it. I think if you look at this business, this is about the worst type of company to own at this moment in the evolution.
Why?
Of it.
Come on.
Because it is a combination of a challenged industrial business and a very challenged financial business. And quite frankly, if you're a professional investor, you don't have to own a conglomerate. If you like the financial plays now, there are plenty of pure plays. If you like industrial, there are plenty of industrial plays. But when you look behind the numbers that were released this morning, and they're just sketchy preliminary estimates, it's not a full 10Q presentation. They may have some additional schedules.
But they said orders were coming back, for instance.
Orders need to be perfected, and they need to actually be financed, and they need to be paid for. And when you actually look at the pre-tax income in this business, compared to 2008 in aggregate, it's down. When you look at revenues, they're down. When you look at the fourth quarter, down and down. And it just doesn't make sense to me to be excited about a business that has declining revenues and challenged pre-tax income.
Now, I know why you say this, partly because you and I have talked quite a bit, is that you're quite pessimistic about the economy. So no wonder then you say that you wouldn't want to be an industrial. Okay, before we move on to other things, though, to tackle the financial part of it with GE,
sure.
To your credit, in terms of what you've been saying all along, is that they haven't tackled these the bad debts, the assets on their balance sheet, and you don't see any more evidence of that, right?
In every industry, there's a food chain, and in the financial services industry, there is certainly a food chain. And if you look at the people who are running capital finance, GE Capital Services, I would argue they're running it directly into the ground. To say with a straight face that capital finance was profitable when it lost money at the pre-tax line and only delivered an after-tax profit because through tax wizardry they got tax refunds greater than their pre-tax loss is to miss a fundamental point that this business has way too much debt on it. In aggregate, it has $500 billion of debt. A big portion of that debt was garnered through the TLGP program, under circumstances which I question.
Well, but do you think they're going to get hit by this, Obama?
Absolutely. I think, I think in the past, when the entire financial services industry was, helping this economy grow rapidly, it was fine to be a bank like GECC that was sort of away from the radar screen, not really as intensively regulated as some of its peers. But now you're in a place where yesterday I heard the president and his gang of advisors declare war on banks. I mean, how much sense does that make?
Or war on capitalism is another way to put it. Okay, Charles, Buffett is another subject we talk about quite a bit with you. This whole thing with Kraft, it's so interesting that they went ahead with this deal anyway, even though he's publicly criticized them.
Yeah, I mean, he's a large investor in Kraft, obviously. I think he has around 10% of the company. I'm sure they do listen and respect him, but he's not in a position of control in that company. I think with regard to both businesses, with regard to GE and with regard to Buffett, you have to question the wisdom of an acquisition-led growth strategy. I mean, you go back to 1999 in both companies, and you look at how their stocks have fared. They haven't created value for shareholders. They've destroyed, in a nominal sense, a lot of value. If you norm their performance to gold, it is an abysmal performance.
Right.
And in the case of Buffett, to simply pay a big control premium for Burlington and then say he's going to hold on to it for 50 to 100 years, how do you amortize that control premium? What does the head office at Berkshire Hathaway bring to the table to do a better job for Burlington Northern than it could do on its own?
Okay. All right, we're going to have to leave it there.